Welcome to Pro News Weekly. Let's dive into the updates on the financial markets. The US dollar accelerated its decline against its major peers, losing around 1.5% in the first half of the week, before trimming losses to 1%. Fundamentally behind the dollar's corrective pullback is the resurgence of expectations that the Fed will cut its key rate once or twice later this year. We recall that in early January, markets were pricing in a 30% chance of no rate change. On the tech analysis side, the DXY pullback from 110 to 108 is within the scope of a typical correction. Also in favor of a corrective scenario is that the dollar got support this week on the decline to the 50-day moving average near the November peaks. A test of this could be repeated next week. A failure under 107.50 would force a deeper decline to 106, or potentially even 105. The ability to quickly return to the 110 area would make the 115 to 116 area the next bullish target. U.S. indices maintained a positive trend for the second week in a row, with the S&P 500 setting a new all-time high above 6,100. The NASDAQ 100 and Dow Jones are about 2% below their records, but have broken the downtrend that has been building since the second half of December. Next week's central event will be the Fed meeting. In December, the central bank's tough tone took about 4% off each of the key U.S. stock indices. The markets managed to recover these losses due to strong macroeconomics and company reports. Nevertheless, there are still some concerns that the Fed's stance may once again deliver an unpleasant surprise. The price of gold is rising for the fourth week, having added over 2.5% in the last 5 days. With the price of an ounce around $2,750, the price has reached the area of historical highs at $2,793. The dynamics indicate the completion of the corrective pullback and a new attempt to storm the historical highs. Among the reasons for growth is the threat of tariffs from the U.S. These threats are building traction into security. It also caused the rest of the world to ramp up domestic stimulus, pressuring national currencies and pushing up commodity prices, including gold. The stalled dollar rally is also on the side of bullion buyers. Technically, a consolidation above 2,800 would open a direct path to the 3,400 area, which is more than 20% above current levels. In the outgoing week, Bitcoin updated its all-time high, approaching the price of $110,000, pulling the entire crypto market up with it. The total crypto capitalization exceeded $3.7 trillion after falling back to $3.5 trillion. The market needs time to adapt to the current heights. Meanwhile, the sentiment index was cruising in the greed zone, only once reaching extreme greed. As was the case in mid-December, high sentiment index values intensified selling. Bitcoin fell below 100,000 during the week, then approached 110,000 and smoothly re-emerged at 102,000. Sales intensified as the peak of 110,000 was approached in December and January. However, support has also moved above 100,000, meaning market participants are getting used to a six-figure price. The new week will be packed with monetary policy news. Most observers expect the Bank of Canada to cut its key rate by 25 points to 3.0% on Wednesday, the 29th of January. The previous two cuts have been 50 basis points each, but traders can't completely rule out hints of a pause in the next meeting or even in this one. Next, the Fed will take the stage, where it's expected to keep the rate on hold after 3 rate cuts. The main intrigue is the Fed's view on inflation and the outlook of monetary policy for the rest of the year. Expectations of 1 or 2 rate cuts have been building again in recent days, which has halted the dollar's rise. On Thursday, the 30th of January, the ECB is expected to cut its key rate by 25 points. This could be the first of 4 cuts expected from the Eurozone this year. The approach is softer than its rivals. On Friday, the 31st of January, attention will turn to the U.S. Personal Consumption Price Index data. This is the Fed's main inflation benchmark, and this metric shows an acceleration in price growth over the past 6 months. A slowdown is favorable for equities and negative for the dollar. Stay tuned to Pro News Weekly for more updates on global markets. Like, share, and subscribe.